You've been there. The quarterly budget meeting. A slide goes up, dense with numbers and acronyms. The CFO starts talking about EBITDA, amortization, and accounts receivable. You nod along, trying to look intelligent, while one question screams inside your head, where are they getting those numbers? That feeling of being on the outside, of not speaking the language of the people who control the purse strings, that ends today because your great ideas are dying in those meetings. They're being set aside, not because they're bad, but because you couldn't frame them in the only language that truly matters in business, the language of money. Forget boring textbooks and confusing jargon. We are going to install the 3 core pillars of financial literacy directly into your brain. By the end of this video, you won't just understand the numbers, you'll be able to use them to your advantage. Let's begin. To decode any business, you only need to understand 3 documents. That's it, not 50, 3. Think of them as the company's report card, its net worth statement, and its bank statement. This is the financial trinity. First, the income statement, also known as the profit and loss or P&L. This is the company's report card for a specific period, a quarter, a year. It's brutally simple. It lists all the money the company earned, called revenue, and subtracts everything it spent, called expenses. What's left is the bottom line, net profit or net loss. Is the company winning or losing the game right now? The income statement tells you. Take a moment to review the key points on screen before we continue. Second, the balance sheet. This isn't a story over time. It's a snapshot, a single photo of what the company owns and what it owes on a specific day. This is where you find the single most important equation in all of finance. Assets equals liabilities plus equity. Your assets are everything the company owns that has value. Cash, equipment, buildings. Your liabilities are everything it owes. Loans, supplier bills, and equity, that's what's left over for the owners. It's the company's true net worth. Think of it like your house. The house's value is the asset. The mortgage is the liability. The amount you've paid off is your equity. The equation must always balance. It's a law of the universe. Third, and most misunderstood, is the cash flow statement. While the income statement talks about profit, this statement tracks actual, physical, or digital cash. It shows where cash came from and where it went. It's the difference between your friend who earns a $100,000 salary, that's their profit, and the actual cash they have in their wallet after paying their mortgage, buying groceries, and servicing their crippling addiction to vintage action figures. Profit is an opinion. Cash is a fact. So to recap, the income statement is your report card. The balance sheet is your net worth. The cash flow statement is your bank account activity. That's the core skill. Simple. All right, you've got the basics. Income statement shows profit, balance sheet shows worth, cash flow shows cash. Easy. But what happens when these things tell you a different story? Here's the pivot. A company can be wildly, fantastically profitable and still go bankrupt. Read that again. It can be a smashing success on its income statement, with profits soaring sky high, yet still have the lights shut off and the doors chained closed. How is that possible? If you're making a profit, shouldn't you be swimming in money? So, this is where it gets interesting. Timing matters. It's the single most critical concept that separates financial amateurs from professionals. When your business recognizes and receives revenue and expenses can dramatically change your financial picture. Financial statements may use one of 2 methods to recognize the timing. The cash method records transactions when money changes hands. The accrual method records them when they're earned or incurred, regardless of cash flow. There is a big difference in how that impacts your cash position. So clearly understanding finance lies in the gap between profit and cash. Remember, profit is an accounting concept. Cash is reality. Here's how a profitable company dies. Scenario 1, the customer hasn't paid yet. Let's say you sell $1 million worth of software to a big client. On your income statement, congratulations, you just booked $1 million in revenue. After your expenses, you might have a handsome $500,000 profit. You are, on paper, a genius. But the client's payment terms are 90 days. For 3 months, you have 0 cash from that sale. But you still have to pay your own bills. Your engineers need their salaries. Your rent is due. Your profit is trapped in an invoice, an IOU from your customer. This is called accounts receivable on the balance sheet. It's an asset, but you can't spend it. Scenario 2. Massive spending that isn't an expense. You decide to build a massive new factory. That's a $5 million investment. That $5 million leaves your bank account this year. It's gone. But for accounting purposes, that factory isn't a one-time expense on your income statement. It's a capital expenditure. It's an asset that you will depreciate or expense in small chunks over the next 20 years. So your income statement looks great this year. Only a tiny sliver of depreciation is counted as an expense. But your cash flow statement shows a $5 million hole. This is how it happens. The company is profitable because of sales it hasn't collected cash for, while simultaneously spending huge amounts of real cash on things that won't fully count as expenses for years. The income statement says, we're brilliant. The cash flow statement says, we're broke. And the cash flow statement always wins. You can't pay salaries with profit. You pay them with cash. This is why you must look at all three statements together. They are a system of checks and balances. One tells a story, the other two confirm if it's true. Here's another key concept to grasp. Fixed versus variable costs. Fixed costs are your financial anchors: rent, salaries, insurance. They stay constant regardless of how busy you are. Variable costs fluctuate with activity: raw materials, commission, shipping. Understanding this distinction is your secret weapon for making smart business decisions. So, you are no longer the person nodding in the dark. You understand that profit is not cash, and not all expenses are the same. You understand the holy trinity of financial statements. You now possess the foundational knowledge that underpins every business decision, but knowledge without action is useless. Here's your power move: master ratio analysis. 4 ratios will make you dangerous in any financial discussion. 1. Gross profit margin. Gross profit divided by revenue shows pricing power and efficiency. 2. Current ratio. Current assets divided by current liabilities shows short-term financial health. 3. Debt to equity ratio. Total debt divided by total equity shows financial leverage. 4. Return on investment. Net income divided by investment shows profitability of investments. Budget performance isn't about hitting numbers, it's about understanding variances. When actual results differ from budget, ask 3 questions. Why did this happen? What can we control? What should we expect going forward? So here is your launchpad. Your mission, should you choose to accept it. Find the most recent annual or quarterly financial report for your company. Or pick any public company you admire: Apple, Tesla, Starbucks, it doesn't matter. Ignore the 100 pages of corporate jargon. Find 2 things: the consolidated statement of operations, that's the income statement, and the consolidated balance sheet. First, look at the income statement. Find the total revenue and the net income. Divide net income by total revenue. That number is the net profit margin. Is it 5%, 10%, 20%? That simple percentage tells you how much of every dollar in sales the company actually keeps as profit. Second, look at the balance sheet. Compare this year to last year. Find one number under assets or liabilities that changed significantly. Did cash go way up? Did debt go way down? Or way up? Don't try to be an expert. Just find the number and ask yourself one simple question: why? Looking for another way to flex your skills? Look at your department's budget. Calculate your gross profit margin. Understand your fixed versus variable costs. Identify one expense you can convert from fixed to variable or vice versa. Ask questions like, how does our current ratio compare to industry standards? Or, what's driving the variance in our quarterly expenses? The language of business is finance. You now speak that language fluently enough to contribute meaningfully to strategic conversations, not just operational ones. Remember, financial literacy isn't about becoming an accountant. It's about becoming indispensable. When you understand the financial impact of your decisions, you don't just execute, you strategize. You don't just participate in meetings, you add value to them. The numbers are no longer a mystery. They're your competitive edge.